This week, the world got the one headline it had been praying for: peace. And the market celebrated it by erasing $40 from a barrel of oil. I'm Kelly, and this is Flow Finance. We follow the money behind the headlines. No hype, no noise, just where the money actually moves. Let's start with the number that moved the whole world this week: the price of a barrel of oil. Back in February, the United States and Israel went to war with Iran. And the moment that war started, traders did the math on a nightmare. Because Iran sits right on top of the single most important choke point on Earth, a narrow stretch of water called the Strait of Hormuz. It's barely 20 miles wide at its tightest. And about a fifth of all the oil on the planet has to squeeze through it, on tankers, every single day. We're talking around 20 million barrels of oil. Every single day. Sliding through a gap you could sail across in an afternoon. One country with the power to put a cork in a fifth of the world's oil. That is not a small amount of leverage. And here's what makes it so dangerous. There is no real backup. A few pipelines can carry a trickle around it, but nothing close to what those tankers move. Shut the strait, and a fifth of the world's oil has nowhere else to go. So a threat to close it isn't a local problem. It's a price shock for every driver, on every continent, at the same time. So when the war began, the market didn't just worry. It priced in the nightmare. The price of oil climbed from around $70 toward $120 a barrel. And this was no idle fear. Early in the war, Iran declared the strait closed and threatened any ship that tried to cross. Tanker traffic collapsed toward zero. The cork was really in the bottle. Picture what the market was staring at. A fifth of the world's oil cut off. Gas lines. Inflation roaring back. Central banks trapped. That entire scenario lived inside that $120 price. And then, slowly, that nightmare started to come undone. Over the spring, as a ceasefire went from rumor to real negotiation, the fear began draining out of the price. And this week, it finally broke. The United States and Iran signed a framework to end the war. A deal to stop the fighting, reopen the strait within 30 days, unfreeze some Iranian money, and ease some of the sanctions on its oil. And oil fell off a cliff, below $80 a barrel for the first time in nearly 4 months. From $120 at the peak of the panic, down toward $80, roughly $40. Not because the world suddenly found new oil, because the world stopped being afraid. So here's the first thing I want you to really understand, because almost nobody says it out loud. Not a single new barrel of oil was pumped to make that price collapse. Nothing physical had actually changed yet. The strait was still closed. The ships were still stuck. The only thing that moved was what changed was fear. And it turns out fear was worth about $40 a barrel. Here's how that works. The price of oil isn't really set by what's in the ground today. It's set by what people are afraid might happen tomorrow. Traders call it a risk. The rest of us can just call it an anxiety tax. When a war threatens to choke off a fifth of the world's oil, every buyer on Earth scrambles to lock in barrels before the price explodes. That scramble is what pushes the number up. And the second that threat lifts, the scramble reverses. Everyone exhales at once. The premium evaporates. And this is nothing new. Oil has always been priced partly on nerves. Every time that part of the world tenses up, the price jumps. Every time it calms, the price sags. The barrel is half commodity, half mood ring, which means a huge slice of what you pay for energy year after year is really just the world's collective anxiety billed to you by the gallon. You weren't paying for oil. You were paying for the possibility of no oil. And that possibility just got a lot cheaper. And there's a second engine pushing the price down, one that's only just getting started. The deal eases sanctions on Iran's own oil, which means, over the coming months, more Iranian barrels flow back onto the world market. Less fear today. More actual oil tomorrow. The price is feeling both at once? A signature in a room in Switzerland did what no oil field on the planet could do that. Now, this is the part of the story where everyone wants to celebrate. And there's a real case for it. Cheaper oil is, genuinely, Good news for almost everyone watching this, because oil isn't just what's in your gas tank. It's in the truck that delivers your food, the plastic in your phone, the fertilizer that grows your dinner. When the price of oil falls, the price of moving and making almost everything falls with it. It works like a quiet tax cut for the entire world economy. So yes, lower oil is a real gift. Markets rallied for a reason. But this is flow finance. So let's follow the money one step further than the headline does, and ask the question nobody on the celebration stage is asking. If peace is so cheap, who's actually paying for it? Start with the most personal place, your gas tank. The price on the trading screen fell in milliseconds. The price at your local pump will not. Analysts are already warning that drivers may not see pre-war gas prices again until 2027. The market gets its relief this afternoon. You might get yours next year. And it's worth knowing why the pump is so slow. The gas in your tank wasn't bought this morning. It was refined weeks ago from oil purchased on contracts signed before the deal. Stations are still selling down fuel they paid full price for. On top of that, refining, taxes, and local margins all sit between the global price and the number on the sign. The barrel is just one ingredient, and it's not the one that moves fastest. So when oil crashes and your gas doesn't, that's not a conspiracy. It's just the long, sticky distance between a trading screen and a street corner. And the physical world is even slower than that. Reopening a shipping lane on paper is not the same as actually moving the ships. By some estimates, around 500 large commercial vessels are still stuck in the region, waiting, and the world's oil reserves, drained during the war, could take a year or more to refill. The screen says peace. The ocean hasn't gotten the message yet, so that's the first group paying for the celebration. Everyone who needs the real physical world to catch up to the headline. And the real world moves at the speed of tankers, not tweets. Now here's the second group. And this one is less obvious. The people who pay for cheap oil are the people who sell oil. There are entire countries whose national budgets are built on oil staying expensive. Whole economies that only balance their books when a barrel sells for $90 or $100. Drop that to $80 or below and their math breaks. Their biggest export is suddenly worth a third less than they were counting on. One country's anxiety tax is another country's paycheck. When the fear disappears, so does the paycheck. And it's not just nations. It's the oil companies, the drillers, the high-cost producers who borrowed money assuming prices would stay high. And there's a cruel order to who gets hurt first. When the price falls, the cheapest oil on earth keeps pumping just fine. It's the expensive stuff, the deep wells and hard-to-reach fields that only ever made sense at $100 a barrel, that gets shut down first. Cheap oil doesn't kill the giants sitting on easy reserves. It quietly strangles everyone who borrowed and drilled betting the price would never come back down. Cheap energy feels like a gift when you're buying it. It feels like a threat when you're selling it. So already, this beautiful piece has a bill attached. It's just sent to people who aren't on camera cheering. But here is where it gets genuinely interesting for your money. Because this one number, the price of oil, doesn't stop at the gas pump. It sets off a chain reaction that runs straight through your savings. So follow it with me, one link at a time. Link 1. Oil gets cheaper, which means moving and making things gets cheaper, which means inflation, the thing that's been eating your paycheck for years, finally starts to cool. And oil matters to the Fed more than almost any other single price, because it feeds, slowly, into nearly everything. So when the barrel falls, that relief seeps into thousands of prices over the following months, which is exactly why central bankers watch the oil price like hawks. Link 2. And this is the big one. When inflation cools, it changes the hand of the most powerful financial player on the planet, the Federal Reserve. This very week, the Fed met, and it did. It left interest rates exactly where they were. And in a week this loud, doing nothing was the most interesting decision in the room, because cheaper oil is the gift that gives the Fed permission. The lower inflation runs, the more room they have to eventually cut rates. And lower rates are rocket fuel for markets. Link 3. The moment investors smell rate cuts coming, they pile into riskier, higher reward bets. And you can already see it happening. Bitcoin held firm, up near $66,000, with analysts openly talking about a run at 70. The logic is simple. Less inflation, less fear of the Fed, more appetite for risk. And it isn't just crypto. Lower rates lift almost everything built on the promise of future growth. Tech stocks, speculative bets, anything whose payoff is years away. Cheaper money makes a distant reward worth more today. But notice the leap of faith hiding in there. The market isn't celebrating a rate cut that happened. It's celebrating one. It's betting will happen. And the Fed hasn't promised a single thing. One peace deal in Switzerland, and the ripple reaches all the way to a cryptocurrency, your gas tank, and your retirement account. All at once. And that brings us to the engine underneath all of it. The one bet holding the entire market up. Because here's the strange thing about this rally. For all the noise about oil and war and peace, that is not what's really driving the stock market right now. One thing is artificial intelligence. We covered this last time, but it's worth repeating because it's the load-bearing wall of your portfolio. Roughly a third of the entire American stock market now sits inside just a handful of companies, almost all of them riding the same bet on AI. And here's why that lands on you. Even if you have never bought a single share in your life, if you own a basic index fund, the kind sitting quietly in most retirement accounts, you already own this bet, heavily. You think your money is spread safely across hundreds of companies. In reality, a big chunk of it is riding on the same few names, whether you ever chose them or not. And that bet is not gentle. Just a couple of weeks ago, the AI stocks had a brutal day. Nvidia, the most valuable company on earth at around $5 trillion, fell almost 6% in a single session. The whole sector wobbled. And then it shrugged it off and kept climbing. Because right now the market has decided AI is the future, and it is paying full price for that future. Peace in the Middle East is a nice tailwind. But AI is the engine. And if that engine ever sputters, no oil deal on earth will catch the fall. So in the same week peace broke out, your savings quietly got more dependent on two fragile things. A framework that isn't finished, and a single trade called artificial intelligence. Now, I want to be fair here, because it would be easy to turn this into doom, and that would be just as wrong as the cheering. So let's put both sides on the table. The reason to be hopeful, and the reason to be careful. In favor of the good news? This is real de-escalation. A war is ending. Cheaper energy is a genuine tax cut for billions of people. Inflation easing gives the Fed room to breathe, and that helps almost everyone with a job, a loan, or a savings account. That case is real, and it is strong. Peace and cheaper energy are not small things. They're enormous. But against it, look closely at what we're actually celebrating. It's a framework, not a finished piece. A handshake, not a treaty. And handshakes in that part of the world have broken before. The relief hasn't reached the real economy, and might not for a year. The oil-producing world just took a hit. It has to absorb somehow. And the market rally is leaning on the same dangerously concentrated AI bet it was already leaning on. That's a lot of things that all have to keep going right. At the same time, for this to stay a celebration. And there's one more wrinkle that should make you raise an eyebrow. This same peace deal has now rallied the markets more than once. Oil and stocks jumped on the hopes of a deal weeks ago, and then jumped again when it was actually signed. When the market celebrates the same good news twice, ask yourself how much of that good news is now already in the price. Because that's the trap with the headline, "This happy." By the time everyone agrees it's wonderful, the easy money has usually already been made. So here's what I actually want to leave you with. Not a prediction. A checklist. Because you don't need to guess what happens next. You just need to watch the right things. So here are 4. 1. Watch the strait actually reopen. There's a 30-day clock on that promise. Paper is easy. Moving 500 stranded ships is not. If the tankers don't flow, the peace isn't real yet. 2. Watch your gas pump. If the price on the screen crashed but your pump barely moves, you'll know exactly who the relief was really for. The traders, not you. 3. Watch whether the Fed actually cuts. Cheaper oil gives them permission, not a guarantee. The cut is the prize. Until it lands, it's just a hope. 4. Watch the floor on oil itself. Cheaper is good until it's too cheap, too fast. Crush the producers hard enough, and you get a different kind of shock, coming from the other direction. And underneath all 4, one simple rule. The market priced this piece in an afternoon. The real world will take a year to feel it. Don't ever confuse the two. The headline and your life run on completely different clocks. Step back, and this whole week is really one lesson, told in the price of a number jumped $40 on fear and fell $40 on hope. And through all of it, the actual amount of oil in the world barely changed at all. And we have seen this movie before. A shock sends a price screaming one way, the crowd panics or celebrates, and months later the world quietly settles somewhere in the middle. The drama is always real. The lasting move is usually smaller than it felt in the moment. So much of what moves your money isn't built on what's real. It's built on what everyone's afraid of or hoping for in this exact. And those feelings are the most expensive and the most unreliable things on the entire market. The smartest money doesn't trade the feeling. It waits for the world to catch up to the headline. And it remembers that the loudest celebrations are usually the most expensive moment to buy in. That's it for today. If you made it all the way to the end of this one, you are exactly my kind of person. I'm Kelly, this was Flow Finance, and I'll see you in the next one.